Welcome to episode 7, Selling Calls on GameStop during the meme short squeeze and after. I'm going to show you how option sellers did on GameStop GME during and after this period. Then I'll consider what strategies we could have used during this period. If you have a time machine, go back and remember not to sell calls on GameStop that expire on January 27th. You can buy calls and you'll do really well. Now, this is not trading advice. Don't do this because I say it worked in the past on GameStop. Just because it worked here does not mean it will work in the future. So this Yahoo chart in the background is 1 year of GME during this time period. If you sold a call here, wow, absolute insanity. What a ride. Not good if it expired here. Not good at all. Or even here, because you probably freaked out and closed out the position here and lost a lot of money. But any time after, say, here, you probably did okay selling calls because the implied volatility and the premiums were so inflated that you did okay. So if this is your first time here, this channel is about running back tests on options, usually selling options, and talking about the results to see if they might apply to future situations. If this sounds interesting, please hit the like button and subscribe. Feel free to request a backtest or feature, and let's get started. Here's one backtest with a certain set of criteria. Each blue line represents the lifetime of selling a call, from date sold to expiration, from here to here or from here to here. It was found in the option quote data and had a volume of at least 2 that day. Days to expiration was 45, and the delta was about 0.15 or a 15% chance of getting assigned. So each option leg has a corresponding yellow underlying leg. The yellow line shows what the underlying did during that same time period as the call. The yellow lines are before the 4-to-1 stock split, so that's why you see this guy going all the way up to like 350, where on the Yahoo chart it only went up to like 85 or 90. So it found 128 distinct legs over this time period, from December 2020 through December 2021. So in January, before the GameStop craziness really hit, there wasn't a lot of interest in these options. But then you can see the frequency and volume really picked up, like tons of calls going on here and here. Just option sellers were really attracted to the juicy premiums and high volatility. As you can see, the first set of calls did absolutely terrible. You just lost tons and tons of money. But if, as time went on, if you continued to sell lots and lots of calls all through this time period, you worked your way all the way back up to even. So let's take a look at the log to get a closer view of the distribution of these legs and see some individual records. So here's the backtest log I just mentioned. This is just one very small sample of all the calls sold on GME during this time period, but I believe it can give some good clues about what happened. We'll look at a larger aggregation of mini backtests in a minute. I've highlighted that there's almost 700,000 GME quotes in the data for 2020 and 2021, but we've whittled those down to 128 for this backtest. We're getting down in the weeds here, so take a deep breath. First, let's look at the monthly distribution. There was only 5 found in December and January before all the craziness happened. and GME erupted. And interest spiked a little in February after it had gone nuts. Sellers were probably too terrified to do much of anything in March after what had happened. However, in May and August, it looked like the juicy premiums had attracted some sellers. I guess they figured it had settled down enough by then. Less chance of another crazy squeeze. Some stats. There were 128 trades, as I mentioned. The max loss was 301, which means on one contract you would have lost $30,153. Ouch. The max gain was 20.7. The total profit loss was -9 or -$900, which is darn close to break even. The average annual yield is interesting. What this is saying is the average annual yield was -330%, which seems way too low, right? Here's my interpretation. During the big down legs, the strikes were very low, so not much collateral was required, which means the annualized yields were insanely negative on those early calls. -18,000% on the two biggest losing legs. So they dominated the later, much smaller positive yields. After the initial spike, the strike prices shot to the moon and required a lot more collateral, suppressing the yields by orders of magnitude. Streaks, or consecutive assigned and unassigned. At the very start, you suffered through 10 consecutive assignments during the short squeeze spike up. First 10 records below in the table. Then you had 118 not assigned after that. That was much more enjoyable. The 15 delta with the implied volatility set the strike so high that they just never went above the strike price. So let's look at the two biggest losers, these two guys here. You got a whopping 45 cents premium for those. You ended up losing $301 on those. After those happened, you were getting nice premiums at insane strike prices. Like, take a look at record 10. You were able to set the strike price at 720, even though the underlying price was only 90. So like, people just thought another short squeeze was going to happen is the only explanation. And you received $7 premium for that. It was still very interesting by the end. It had calmed down some, but like, if we look at the very last record, this one, you'll see the underlying was at $207, and this, you could still set the strike up at 380 with the 15 delta and get a $5 premium. Anyway, let's move on to the bigger backtest aggregation chart, which will show us the behavior across more deltas and DTEs. So here is the backtest aggregation chart. This chart shows three things. The days to expiration down here on the bottom. See 1 week, 2 week, 3 weeks, 1 month, month and a half, and 2 months. The blue bars here show the call delta. So for each DTE, you go up from 1 to 1.5 all the way up to 1.3 for each one of these. And the red bars show the profit loss of each backtest corresponding to the DTE delta. So for example, this one, the biggest one, corresponds to a 7 DTE and a 30 delta. And it looks like this is the worst one, which corresponds to the 31 DTE and the 25 delta. So just eyeballing the chart, It looks like the shorter DTEs on this end did the best, or the 1 or 2 week DTEs. As mentioned, the 7 DTE with the 30 delta did the best by a pretty wide margin. Probably a bit of luck, but maybe something more to it. That happens to be the shortest DTE with the highest delta. We'll take a peek at it in a bit and see if we think there's anything to it. The 3 or 4 week period did the worst. Could just be bad luck. They could have hit the spikes at the worst possible time. And the longer duration did pretty well. Not quite as good as the short duration, but not bad. Maybe the higher delta did a little bit better. Like the 0.3 did really good here. No clear trend in this group. No clear trend in this group. Here it looks like the highest delta did the best. And here, and then here again. So take that for what it's worth. The higher delta seems to have done a little bit better. So here is the backtest chart for the one that did the best. The 7 DTE with the 30 delta. It took some pain at the start, especially the second spike right here. It got down to about 15,000 in the hole. Luckily it missed first of the big spike up. I can tell by this little yellow line. If it would have gotten nailed, this yellow line would have gone way up here and you would have had a corresponding blue line going way down, but no one sold a call with these criteria to get nailed like that. So if you could have stayed on the sidelines until after the second spike here, then found religion and started selling calls all through here, if you would have sold every one of these, you would have went from minus 15,000 to plus 30,000. You would have made over $45,000 profit. I'm sure no one did this, but that would have been a good strategy. Buying calls in this phase and then selling calls in this phase would have been genius. So this whole episode looks like lottery winner syndrome to me. The call buyers made so much money in these first few weeks. They had a huge bankroll to just keep buying calls through this period, and they did. They only did it at ridiculous inflated premiums, and they slowly squandered all or most of their gains. Does this make sense to you? Let me know in the comments. So let's talk about some strategies that would have worked over this time period. First, I would not have wanted to own GameStop over this period. So covered calls is out of the question for me. The stock was just way overpriced. Also, the number of calls that I'd want to sell wouldn't work with covered calls. You'd have to own a lot. Naked calls are also a little too risky for me, especially on a super volatile stock like this. So I'm thinking a call credit spread would have been a nice strategy to use. Sell an out of the money call above the current underlying stock price, and then buy a further out of the money call for less than your sold credit. Pocket the spread, rest easy knowing you have protection if it spikes up. Hopefully collect all that premium. Looks like shorter DTEs worked a little better for this use case. Middle DTEs maybe were a little unlucky, so I'd go with either short DTEs or long DTEs. So that's it for this GameStop episode. Thanks for watching until the end. Please like and subscribe. We took a look at how option sellers did during and after the GME meme stock short squeeze. I opined on things that would have worked over that time. I'm not a financial advisor. This isn't financial advice. Do your own research. It's just a peek at the data with some comments. I'll start posting some results of backtests soon on the website that you see in the background. The software is still evolving. I just added filtering on minimum volume since last episode. And please comment if you have any thoughts or would like to see any backtests or features.